Good morning to everyone. I'm hoping you're all fine and, like always, ready to take a course of today. I welcome you all to yet another session of financial reporting. Today is the lecture number 7. And in a moving forward, we have a topic of lease today. It's a very important topic, a lengthy one. We will try to finish the topic by the maximum of, but for surely it's going to take the whole course of today. We've been spending the good amount of time on some important areas the past few sessions, like impairment of assets we have done the last week, chapter 7. Like usual, the way we do a lot of board explanations, lecture notes, summary notes, and once the topic is finished off, we do the exam style questions practice. Intangible asset was in discussion before than that. Property, plant and equipment, borrowing cost, investment property, the government grants. All of these reporting standards, majority of them were the newish ones that you never have done in your accounting studies before. But now you have gained the knowledge of that. And this should give you a bit of an happiness that I have become more knowledgeable by taking this course. Ultimately, my objective is to pass this financial reporting course at the level 2 to move forward. But the other best part of this course is that I keep myself more and more knowledgeable. With every week passing, I become more knowledgeable than I was yesterday. And just the way today, you people now will gain a detailed understanding of how the way the leases are accounted for, which is going to be the chapter 8 of ours. Let's connect ourselves to the board so that we can start the course of today. The standard is IFRS 16. The title of the chapter is leasing, and the number of the chapter is chapter number 8. But let's be on the board work. I always come to reveal the way the things are written back into your lecture notes after when I'm done explaining. This has been the whiteboard explanation file, which already has got many things written, pre-written. The summary. Usually I have a tendency to provide you with the summaries. But when I do not, I provide you with my handwritten summarized notes. It is that document within which quite much of the topic is pre-written in summary manner, and many additions I will do in like examples, question solving. And at the end of the day, you get the copy of that, like always, in the PDF on the portal. So let's start ourselves by defining the lease contract. And most of you in the course by this time of the life that you're in, you may have been aware of what is lease contract. But if I have to formally define a contract or an agreement by which the lessee gets the use of asset by making the payments of rentals to lessor for an agreed period, is called as lease contract. So the lessee gets the use of an asset. Why? Because lessee compensates the lessor in the shape of rentals over the period. The life of the lease can be 2 years, can be 5 years, can be 10 years. For that number of years, the lessee is required to pay rentals. and for that exact number of years gets the use of an asset. That contract is called as lease contract. So who is lessee in that? Who is lessor? I'll come to reveal it. This picture will come to reveal everything. Considering A PLC is to be a lessor and B PLC to be a lessee, where the lessee gets the use of an asset by making the payments of rentals to lessor. So who is a lessee then? User of an asset. And who is a lessor? The owner. So the lessor is the one who leases an asset out. And lessee, the one to whom an asset being leased out, which in this case is B PLC. To whom an asset being leased out to is called as lessee. But who leases it out is called as lessor, is the owner of an asset. B PLC will just be the user of it. Over the life, for the number of years the B PLC will pay the rentals for the same number of years will be getting the use of it. At the end of the contract, the ownership might pass on to lessee, might not. That depends upon the type of the contract that they are in. But ownership to pass on is not necessary. Can be, cannot. But over the lease term, one thing is for sure, A PLC remains to be the owner of an asset and B PLC just uses it over the life. Ownership can be passed on at the end of the lease term, which cannot even be at times. It is a rental contract where one of the party has to pay a rent, the other has to receive. The one who pays the rent gets the use of an asset. In a very simple way, on the first page, that is the only thing that I have defined. In everyday language, not using any technical, accounting, scientific language over here. Very simple words I have used to define the lease contract, and this definition below also comes to explain to all of us. An asset by which we will be only tested in our course, the accounting of lessee, examinable in FR, only examined in FR. Lessor accounting is not examined. Accounting for the lessee is only examined in FR. I can highlight it in some more eye-catching color. Lessee's perspective is only examined in FR, not the lessor. So we will have to assume ourselves lessee throughout, who will be paying the payments of rentals, getting the use of asset. So how we will account for this arrangement in accounting, this topic is all about. So is it good that lessee is the one to whom an asset is being leased out? Lessor is the one who leases it out. Who leases it out? To whom an asset is leased out is called as lessor. Who leases it out is lessor. To whom an asset is being leased out is lessee. So a contract by which one of the party will pay a rent, the other will receive. And by that, whoever will pay a rent will be given a permission to use an asset. Owner, the lessor will remain to be throughout, which in the end may pass on the ownership to lessee or may not. That depends on the type of the contract that they are in. Mostly, the ownership passes on to the lessee at the end of the lease term. Mostly. Like taking an example of yours, if you go and take a car from a bank on a lease, then for the number of years you have taken a car on a lease from the bank, you will pay rentals to bank. But after say 5 years, the ownership will be passed on to you for your car. That's yours. So commonly, the ownership passes on to the lessee at the end of the lease term. But like I said, it's not necessary. Can be not be. What is lease term? A non-cancelable period for which the lessee has been granted the right to use it by the lessor. It is also called as prime period of lease. A non-cancelable period means a period that cannot be cancelled, that cannot be terminated. A non-cancelable period for which the lessee has been granted the right to use it by the lessor. Granted means permission, because the lessee has been given a permission by a lessor to use an asset, because whose asset is it actually? Lessor. And the lessor is permitting lessee to use that asset, because the lessee compensates the lessor in the form of rentals. So it's like a grant of right to use it. So non-cancelable period for which the lessee has been given a right to use it by the lessor, including the period of extension. These are called the secondary periods of lease, which can be including, which cannot be including. Totally depends upon. I'll take the first case into my detailed talk, period of extension. Considering this example down below, let me add one page further into to explain. A Limited takes an asset on a 5-year lease. The lease contract allows A Limited to extend the contract, say for further 3 years. Now, A Limited takes an asset on a 5-year lease, which is a basic non-cancelable prime period of lease. Now, the contract allows the lessee to extend the lease term for further 3 years. So what will be the term of the lease? My question mark is, what will be the term of the lease? First of all, 5 years is definitely going to be there, which is called as non-cancelable period. Non-cancelable period. The 3 years to add in is in fact the period of non-cancelable period. This is option to extend period. This is option to extend period. Option to extend period. So do we really have to include that in it or not? It totally depends upon the expectation of lessee in that given moment. So if I can make that assumption that the lessee is likely to extend, if the lessee is likely to extend, if the lessee is likely to extend, if the lessee is likely to extend, then I will include that one to say that the term of the lease is not just 5 years, but also 8 years, 3 years, plus 8 years. But if the lessee is not likely to extend, then the lease term is gonna be only 5 years. The lease term is gonna be only 5 years. The lease term is gonna be only 5 years. Are you getting it? It totally depends upon the behavior of the lessee, the expectation of the lessee, the requirement of the lessee. If the lessee is likely to extend, means the lessee will be wishing to use that asset for 8 complete years. So the lease term that is useful to lessee is gonna be 8 years. But if the lessee is not likely to extend, means the lessee is wanting to use this asset only for 5 years. So that is gonna be the term of the lease in that case. So the same word has been used, provided the lessee is likely to extend, certain to extend, hopeful to extend, probable to extend. Chance of extension is likely there, probable there, certain there. Then we will come to include this in the basic to say that the total life of the contract is 8 years. Otherwise, if the lessee is not likely to extend, that means he wants to exit the contract after 5. So the useful life to the lease is gonna be 5 only years. Similarly, another question I can put forward and we'll try to determine the lease term out of it. The lease, as the A Limited takes an asset on a 5-year lease, lease contract allow A Limited to terminate, not to extend, terminate the contract after 3 years. So what is going to be the lease term over here? Total life is 5 years. Total life 5 years. Out of 5 years, 3 years are non-cancelable. In the first 3 years, the lease cannot be cancelled. In the first 3 years, the lease cannot be cancelled. The lease cannot be cancelled in first 3 years. In those 2 years, this is called as option to terminate period. This is called as option. See, after 3 years, it can be cancelled, not before. So first 3 years are non-cancelable then. The 2 next years are. So for this one, I can write a word likely to terminate. Likely to terminate. Likely to terminate. So if the lessee is likely to terminate the contract after 3 years, then what's useful to lessee is going to be the life of 3 years only. Is going to be the life of 3 years only. Is going to be the life of 3 years only. That one I will go to exclude. It will not be included. So for period of termination to add, the chance of termination should not likely to be there. Unlikely to be there. Chance of termination should not be certain. Then this period will then only include. But here my assumption is that the chance of termination is on the cards. The chance of termination is certain. So I will not include it. I will only go to take this to be the year of the life of the contract. So it all depends upon the chance of extension is there or not. Chance of termination is there or not. For extension to add, chance of extension is likely to be there. For termination to add, chance of termination should not likely to be there. That totally depends upon, like I said, practically speaking, the behavior of the lessee, expectation of the lessee. Are they really terminating? Are they not? If they are terminating, don't include it. If they are not terminating, include it. If they are not likely to extend, don't include it. If they are likely to extend, include it. These 5 years are non-cancelable, which in this case was 3 years, because they give them the option to terminate after 3. First 3 years are not cancelable. After 3, they can. So this is the definition of the lease in detail I have done. I can show to all of you where all this back into lecture notes is being written. But we are right now in the phase of defining what is lease contract, the definition of who is lessee and who is lessor, and the terminologies like the lease term. Basically, a contract where one of the party will have to pay a rent just to get the use of an asset over the life. Ownership can in the end be transferred or not. That depends on the type of a contract, which commonly is going to be a case that the ownership will pass on to the lessee at the end of the lease term. The accounting for the lessor is not within our scope. Accounting for the lessee is only examined, which is where we are going to focus now. You see me writing the word lessee over here. Even if I was not writing, it is obvious that you will be asked to answer the lessee's accounting. As I have told you, in examinable in FR is only the accounting of lessee. Accounting for leasing. 2 of those types of accounting you can see below. The one is simplified accounting. The other one is single lease accounting. Simplified and single lease accounting. Simplified and single lease accounting. Simplified or single lease accounting. Now, this is an option. And this one is by default applicable. This one is by default applicable. Means almost all the contracts of the lease, they follow this method. But this one is rarely used in some limited circumstances, and I can tell you when. This will take us about 45 minutes of talk, and we can finish it in the first place. And then the focus of the course later on will be totally on that. So let's start ourselves with simplified accounting. When can we apply and how can we apply? See, the way that the summaries are made, that makes the whole topic look very interesting, easy to learn, easy to remember. That's simplified accounting being summed up on one page. So like I said, simplified accounting is an option. And we can opt for this option in 2 possible scenarios. When can this be exercised? When the lease is a short term or the value of an asset has to be a low one. What makes the lease to say a short? What makes the lease to say a short? What makes the lease to say a short lease? If the duration of the lease is less than or equivalent to 12 months. If the duration of the lease is less than or equal to 12 months, it's called a short lease. Anyone who will ask you what is short lease, you will say 12 months or less. Or the asset has to be a low value. What makes an asset to say a low value? If the value of that is US $5,000 or less when newly purchased. All written in such a way that you even will not need me to even say a word about, because it's well written. The duration of the lease is less than or equal to 12 months. The value of an asset is less than or equal to $5,000. When new, importantly, not that it's the depreciated value or it's the fair value that may have been dropped down. 5,000 means whenever you have purchased, the price that you have paid is less than or equal to that $5,000 or less. It costed you $5,000 US or less. The word or is used in between. That means either this way or that way. May it has a short life, or may the value of an asset is to be a low one. In both situations, it can be applied. The lease has to be a short one. What makes the lease to say a short one? 12 months or less. The asset value has to be a low one. What makes the value of an asset to be a low one? $5,000 or less. How to apply? Simply, the rentals, they have been making the payment of that out. They will expense that out. Rentals are expensed on a straight line basis. Normally, how do you treat that expense? Normally, you come to expense the cost of repair, anything, insurance expense, repair cost, interest cost, or any cost that you name it. Don't you expense that out to profit and loss? So this is going to be another thing to expense out. Rentals are expensed. Correspondingly, in the statement of financial position, you might end up getting an accrued expense or prepaid expense. It depends on if the payment was less than to what the cost was incurred, or if the payment was more than to the cost was incurred. You can relate this to your basic accounting, that when the cost that you have incurred not been paid or less paid, it results into an accrued expense. It results into an accrued expense. But if the payment has been made in advance or in excess over to whatever the cost being incurred, it's called as prepaid expense. Or if the payment does not differ, or the payment exactly matches it up with the cost, whatever that has been expensed, neither the prepayment nor the accrual will arise. So it all depends upon the mismatch of the payments being made to what the cost has been incurred. But if the two of those things are same, neither the prepayment nor the accrual will arise. But profit and loss will have to take an expense. That is something you have to remember in simplified accounting. So the name of the method is simplified accounting, because that's the simplest way of treating any other expense also in accounting. But just the way, take an example of salary expense. Don't you expense the cost of salary to profit and loss? Now, if the salary was not paid, becomes a payable. Or if the salary has been paid in advance, becomes a what? Prepayment. Or if the payment matches up with the cost that has been incurred, neither the prepayment nor the accrual will arise. Talk about the expense of insurance, talk about the expense of repair. Just the way that normally any expense in accounting you treat, this one will also be. But making it show that two of the circumstances within which you are allowed to opt for the simplified accounting, there is no third possibility in. Even after the lease is a short or the value of an asset is a low, not necessarily you will have to use it. I did not say that the simplified accounting must to be used. I said it to you, it is an option, that if you wish to opt, then you have these two possibilities within which you can opt. But you may still not opt. You may still go by the model that we have yet to explore, single lease accounting. So don't get me wrong, simplified accounting is not the thing that you must have to apply in these two circumstances. You can, you still cannot. But if you wish to, then the circumstances will be either of these two, not any third one. Now we have got questions to work on that to recall ourselves in this basic accrual prepayment accounting. So I will land myself onto the page this topic has been explained. And there you go. The simplified accounting 8.6. The lessee has a choice of applying the lease accounting model, which is what I'm calling it as single lease accounting model, or simplified accounting in two situations. These two situations are the same as I have talked about. Definition of short lease is 12 months or less. Definition of low value is $5,000 or less. So this is from where I make those summaries from to make the task more eye-catching. So what is the accounting treatment? Simply, we have to recognize the lease payments on a straight line basis over the lease term. Lease payments are in fact the rental payments. And now we have got some questions to work to really recall ourselves with the debit credit of accruals and prepayment. Illustrative example 8.5 is coming to our way on the first. Let's go and do that. Illustrative example 8.5. Illustrative example 8.5. Skipton leases a car for 1 year. On 1st of September 9, paying the $500 per month in arrears. A deposit of $500 is payable at the start of the lease. Okay. How should this be reported in Skipton's financial statements in the year ending 31st of December 2009 and 10? So the first year ends on December 9. The start of that has to happen on 1st of Jan 2009. So which day have they taken an asset on a lease? 1st of September 2009. How many months to run? September, October, November, December, Jan. No, September, October, November, December. There are 4 months to run from that point of mark to this. There are 4 points to run. 4 months to run. Noticing the fact that this lease has a term of 1 year. Also, they have provided us with the rentals are $500 a month, monthly. And then we have those deposit. One-off. Deposits are always one-off. Do not even have to write one-off. It's too obvious. One-off. They have asked us to do the accounting of that. So I will do that for first year, which is 2009 right now. This is the rent account. Okay, we will have to find the straight line expense on the first. Just the way we depreciate the cost of an asset by using that straight line method, we also have to use that technique in finding the straight line expense. Can we apply the simplified accounting or no? Yes, we can. Why? Because this is genuinely a short lease. So we can definitely apply the simplified accounting. How to? You should not be forgetting straight line expense. How to find that straight line expense? 500 multiplied by 12 times. This is what they will pay because it's a contract of 1 year, 500 for each month. If they have to pay for the 12 months, they will pay a total of 6,000. Within which I will also go to top up the deposit in it. The deposit has been topped up in it. And then I will divide this by a term of the lease, which is 12. To get me an answer for each month, that's going to be like 550. 550. This is the monthly expense, which we will have to try and deduct. This is called a straight line rental. See, if the question did not involve deposit, that would have been a monthly expense. But that deposit is an extra cost to a lessee. And this needs to be even allocated over the life. And when I came to allocate this 600 over the life, it gives me $1.50. When that 50 adds up into 500, the figure that we get for each month is 550. And that is what I was calling it as straight line rental expense, 550. cost divided by useful life. So the total cost to the lessee is 12 times 500 plus 600 one-off divided by a life. This is going to be a straight line rental expense. Let's do the accounting now. First thing first, we will have to concentrate on the payments. For each month, they have been asked to pay 500. So how many payments would they be making it then? September, October, November, December. There are 4 payments. So 2,000, a debit of rent expense, and a credit of bank. How did I get this figure out? It's 500 multiplied by 4. It's 500 multiplied by 4, a total of 2,000. A debit of rent, a credit of bank. A debit of rent account and a credit of bank. On top of that, they also have paid a deposit. So that makes me to debit the rent account and credit the bank one more time. So it all requires to have your good observation at the end of the day. Are they paying them in advance or arrears? At the start of each month. So how many payments they will be able to make? 1st September, 1st October, 1st November, 1st December. Cutoff date is 31st of December. So 4 payments of 500 means 2,000 is what they have paid. Our deposit. But now what we are deciding to expense to each year's profit and loss, each month's profit and loss is 550. So 550 multiplied by 4 times is going to be 2,200. With that, I will credit the rent account and debit what? Profit and loss. This is what we are going to record it to each month's profit and loss. 550 into 4 times straight line rental. That is what we are supposed to expense. So rent account takes the credit, profit and loss correspondingly takes the debit of that. So what we have taken it into profit and loss is a straight line expense of 4 months, September, October, November, December. As a result of that, we have found a closing balance onto that side, which is going to be a balance of prepayment, which is going to be a balance of prepayment, which is going to be a balance of prepayment. See, the payment does not match with whatever that they have expensed. This is what they were supposed to expense maximum to this year's profit loss, but they have paid more than to that. So the closing of loss will become an opening for the next year. The closing of loss will become an opening for the next year. That is going to be 2,000. The closing of loss is going to become an opening for the next year. So the closing of loss is going to become an opening for the next year. The figure of that is 400, which has become an opening for the next year, and we'll repeat the cycle now. If they have paid 4 payments in last year, they will come to pay the remaining 8 this time. So 500 multiplied by 8, there is going to be a total payment of 4,000. Bank takes the credit, rent account takes the debit. And same way, if we already have expense 4 months, we will come to expense the remaining 8. 550 multiplied by 8 times, that's going to be 4,400. And upon which this T account will come to its end. This is what this whole accounting is about. And you are doing nothing except you're revising the basics of debits and credits over here. If we have not performed well, we would have never got this cancelled. We would have got a balancing figure here. That means everything that we have done is perfectly right. The same that we have come to expense, the same the debits are even comes to right. If you look into the solution of this application, you will exactly find, first of all, they have worked the straight line answer. And then by the time the year has ended, they have worked the same prepayment as we have. While the time the next year happens, check the payment from the bank is 4,000. And check what has been taken to profit and losses, that 4,400. The T account provides us the better picture of what did we actually achieve, rather by passing just the journals. Good with that? Learning example 8.6. 𝗟𝗏 leases 10 laptops. Learning example 8.6. What do they say? Okay. Now, Woodhouse leases 10 laptop computers on 3-year lease. The laptops are provided new, and each is having a fair value of $600 at the inception of the lease. 10 laptops leased. The fair value of each laptop is given as 600. And the term of the lease is 36 months. For 36 months. Each is having a fair value for less than to that $5,000, which makes me to say that it is a low value. But yeah, this is not a short lease. So by this way, we could have not possibly say that we can apply this. It is definitely not a short lease. It's not definitely a short lease. But by this way, they definitely can apply. If it is not a short lease, but at least the asset has to be a low value one. So the answer is that they are requiring, can they apply the simplified account? The answer is the big yes. Because of this reason. Next up, learning example 8.7. On 1st of August 2007, Asheville leases a truck with a fair value of $80,000 on 36 months lease. Lease payments are $1,500 per month, payable in advance. The incentive is given as the first month rental was provided by the lessor rent-free. The lease has a break clause, allowing the Asheville to terminate the agreement after 12 months without a penalty. Asheville management believe that they may terminate the lease after 12 months. Okay, explain how the lease should be accounted for and calculate the amounts to be recognized in the financial statements in the year ending 31st of December 2007. So the year ends on when? 31st of December 2007. The start of that has to happen on what is the day of the grant? On 1st of August, they have got into this contract 1st of August. So how many months to run from that point of mark to this? August, September, October, November, December. Five months to run from that point of mark to this. And the contract life, they say that the lease of truck with the value of 80,000. Truck leased. For 36 months and the value of the truck is given as 80,000. And the value of the truck is 80,000. This is definitely not a low value. This is more than 5,000. And this lease is certainly not less than 12 months. So I will say that in the first place that this is not low value. And I will say that this is not short term. Cannot apply simplified accounting. But then the twist is they suggest the lease has a break clause allowing the ACCA to terminate the agreement after 12 months without penalty. So out of 36 months, 12 months are non-cancelable. You see, that debate has now come back to our way. Non-cancelable. While the next 24 months are cancelable, or it's option to terminate. So are they really going to terminate? Are they really going to terminate? Are they really going to terminate? Yes, they believe that they will. So if I will not come to include that 24 months thing in it because they are certain to terminate, the contract life turns out to be what then? 12 months. Which definitely is now a short lease. See, everything that we do has an importance. Has an importance. If you have not paid attention to when I was doing that before this talk, then you can see the price that you would pay now. How much important for that, for us to define the term of the lease. Because of that, now we are able to say that this is a short lease, and now we can apply simplified account. Which apparently it wasn't a short lease because of that 36 months of lease term, but turned out to be a short one because of this reason, that option to termination, they are certain to terminate. That means this option to terminate period, I will not add into it. The lease term is going to be that first 12 months within which the lease cannot be cancelled. And when it turns out to be a short lease, we will do whatever we have done in the previous question. And I can repeat that. I can repeat that out one more time, the whole computational process. 1,500 per month they are supposed to pay. There is no deposit. And as incentive, first month rental was provided by the lessor rent-free. Means they will go to use an asset for the first month, but they won't be asked to pay a rent. They will start making a payment of rent as from the second month and onwards. So if I have to find that rental expense on a straight line basis, rental expense on a straight line basis, it will go like that. 1,500 multiplied by 12 minus 1. Now, how did I get this 12 minus 1? Since the lease term is now 12 years. 12 months. It's no longer 36. So I will have to multiply 1,500 with 12 times minus 1 because the first month rental is free. So effectively, I will end up paying 11 months. The cost to me is 11 payments, not 12. First month rent is free. Well, the term of the lease is 12 months. This is going to give me that rental expense to each month, which later I will use to record. So it's 1,500 multiplied by 11 divided by 12, gonna be 1,375. 1,375 monthly expense. monthly expense. I will go and prepare a T account. So how many payments will they able to make? They are asked to pay 1,500 for each month, and they will start making a payment not from 1st of August, 1st of September, because first rental is free. So they will start making a payment as from 1st of November, 1st of September. September, October, November, December. There are 4 payments. And when I'm going to record, I will record 1,500 for 4 times. That's going to be 6,000. But what we will have to come and expense to this year's profit and loss 5 months, as we have noticed. So that is going to be 1,375 multiplied by 7. Sorry, 5. So 1,375 multiplied by 5, it's going to be 6,875. So profit and loss takes the debit of that, rent account takes the credit. This is the amount that we have been able to expense, but the payment falls a little short of. So this resulted into what? An accrued expense of 875, accrued expense. So I have taken about 45 minutes to complete the simplified accounting, and you people have been given a nice revision of how to deal it with that accrual prepayment. This thing has nicely been talked about. You also can see me making the use of this lease term, where the lease term was 36 originally, but squeezed down to 12 by the knowledge that we have gained, we have applied, we are over to it. Now we are heading towards to the main thing, that is the single lease accounting model, or simply called as lease accounting model. This model is applicable to every contract of lease. How will it be applied? It's definitely a lengthy debate, and you have to concentrate as much as you can. First of all, why we are calling it as single lease accounting? Single, why the word single is used with? Because historically speaking, the lease was used to be classified into 2, operating and finance. We still do it, but not in financial reporting courses anymore. Yeah, you still do it in your financial management courses, operating lease, finance lease. But as far as the IFRS is concerned, International Financial Reporting Standards, within which the leases are no longer classified into 2 from the lessee's perspective. So we call it as a single contract of lease. So the word single comes from that. Otherwise, we have 2 types of leases always in the past. Accounting for operating lease was a different story. Accounting for finance lease was a different story. But now, because the IFRS has removed the classification of the leases into 2, so we call it as single contract, single type of lease, single lease. So that is from where this word single has come from. That's the history of it. I can write it alongside as no longer classified into 2. No longer classified into 2. Now, being a lessee, I have to learn this whole model in a very formal manner. Then the life of yours will become simpler, because I have divided this whole debate into 4 steps. That is a step number 1. That is a step number 2. That is a step number 3. That is a step number 4. If you divide the whole of that talk into steps and concentrate on each step at one time, it will become easier to understand, and I will go exactly that. So starting myself off with the step number 1. Now, what happens in the step number 1, being a lessee? I will have to record on the one side the leased asset, and on the other side, liability. Keep that broader thing in your mind: asset debit, liability credit, asset debit, liability credit, asset debit, liability credit. A debit of asset account and a credit of liability. A debit of asset account and a credit of liability. But then we will have to come and understand the idea. That it's called as right of use asset. The proper term, the full length term is right of use asset. Lease liability. Right of use asset and lease liability. Right of use asset and lease liability. Now, you may have heard of this term for the first time in your life, right of use asset. What does that mean, right of use asset? If you go a little slowly on this term, you will start getting to the whole feel of it, the smell of it, the taste of it. Right of use. Remember, when we started this topic, we defined the contract of the lease is a contract within which the lessee gets the use of an asset by making the payments of rentals to lessor. So the lessee has been given a permission to use it. Right, permission, grant, all are the same words. I mean, you can use that in this context. The lessee was granted a right to use it, a permission to use it. So to lessee, it is not an owned asset. It is a right of use asset. So the word, you have to remember it as right of use. Simply can call it as leased asset, but preferably call it the way that the standard has. So an asset for which the lessee has been given a right of use. I already have highlighted this word so that you focus on this word and you'll be able to understand the whole term, right of use. An asset for which the lessee has been given a right to use it by a lessor. It's like an asset for which I have been given a permission to use it. I was being given a permission to use it. So I'm using. So to me, it must have been a right of use asset, not an owned asset. While the lease liability is going to be the lessee's obligation to make those payments of rentals to lessor. If I'm a lessee, what is my obligation? To pay rentals to lessor. So my liability towards lessor is going to be the rental payments, which I have to pay over the life in all those years to come. So lessee's obligation to meet the lease payments is called as lease liability. So right of use asset will be debited. Lease liability will be credited at the value, which is called as present value of the future lease payment. So this value will be given to us in some questions. In some questions, they will ask us to find, and I will explain that to all of you how to find. It's going to be a same sort of a calculation that we were doing it the last week while computing the value in use in impairment topic. Remember, where I was using the first column to write down those cash flows. The next column was the column of discount factors. Third column was the column of present value. So it's gonna be that sort of calculation. We will do it today even. Present value of future lease payment. And these lease payments are going to be the rental payments. So you will write those rentals for next 4 or 5 years and you will discount them to find the present value with which the double entry will be passed. So most of the time, this value will be given, most of the times. If not given, we will have to find. An easy way to find that is to follow that table, which I will do that soon in one question. So once the value is found, we will use that value to record the first step. How long did I spend it to work on the first step only? It's been like from the past 10 minutes, I have been concentrating it on step 1. And I have placed that whole page in front so that by the time I move on to the next page, it's already been digested. It's nothing, because when I'm writing, obviously with my handwriting, it takes more space. Otherwise, if you try to type it in with a font size of 10 or 11, it's gonna be only this part of this page. I, I hope you're understanding what I'm talking about, because I'm writing it with my handwriting. So I'm not taking the care of how large the font is and not using the proper lines, even spaces even. So it takes the whole page. Otherwise, not a whole page of explanation. It's hardly this. If I have to type it in on word processor, it's hardly going to take that much space. So being a lessee, in the first step, asset debit, liability credit. Asset to debit, the full length form of that is right of use asset. The liability to credit, the full length form of that is lease liability. At the value, which is going to be the present value of the future lease payments. In the next step, I will be required to depreciate. Since the asset is recognized, my next job is to depreciate. So the next step focuses on right of use asset and the depreciation of it. Within that also, we have to look into that if the ownership is passing on to the lessee or not passing. If the ownership is passing on to the lessee or not passing. So if the ownership is on passing on to the lessee, we will have to use the useful life to depreciate. And if the ownership is not passing on to the lessee, then we will have to take the shorter of both. You can't get that sort of friendlier explanation more than that, that it's written in such a way that even if I don't have to really talk about it, it's there for you to read it very easily. You can read that. What do I have to explain more than that in it? When it simply says, when the ownership does transfer, use the useful life. When does not transfer, take the shorter of both. And when you are done with, the double entry, the depreciation expense on the one side will take the debit, the right of use asset will take the credit of that. So when the ownership does not pass on to the lessee, you have to take the shorter of two. In most situations, the useful life will be equal to use term. But if it differs, then you have to respect taking a shorter of both. But when the ownership is passing on to the lessee, then you will just rely on the useful life to go with. Knowledge. Keep on gaining that knowledge before we will come to apply that to a first question of ours in next 5 minutes. Third step will require us to calculate the finance cost on liability. So finance costs are recognized based on the outstanding balance of liability at each year end. With that, I will have to debit the finance cost and credit what? Lease liability. So I will have to make sure when I'll go to calculate the finance cost, I will be working it out based on the balance of liability at that year end. Because every year end, the liability will change, since when you will go to pay rentals out. So each time one of the rental will be paid out, the liability balance will fall. And the next year's finance cost will then be based upon that outstanding balance. So finance cost will not be a straight line. It will differ from one year to next, as we are going to calculate the finance cost based on outstanding balance of the liability at each year. And finally, the repayment, which can either be in advance or arrears. Advance means at the start of the year. Arrears means at the end of the year. Bank has to take the credit, liability has to debit, as if you are repaying the loan back to the lender. So you will have to debit the loan account and credit the bank. These 4 steps I will go to literally apply in questions coming to our way. But at least once I have been able to explain by passing it through. Why don't we apply that to first question of ours? And that is going to be the learning example 8.3 on the bottom of this page. So G entered into a 4-year lease finance arrangement on 1st of Jan 2008. You can discard this word finance, even if it is used. Just lease agreement on 1st of Jan 2008. This is the day of the grant. The lease requires to have 4 annual payments in arrears of 17500. The interest rate implicit in the lease is 6.5%, giving a present value of future lease payments of 60,000. The year end is 31st of December. Calculate the lease liability at each reporting date over a 4-year lease term. So the moment I will go to answer this question, I will go to start this question. You will see I'm going to focus exactly on that 4-step approach. The first thing first, I will have to go by writing the step number 1, which requires me to debit the right of use asset account on the one side and credit the lease liability. So I'll have to debit the right of use asset account and credit the lease liability. Luckily, the question provides us with the present value of the lease payments already. So I will just come to use it and debit the asset by that and credit the right of use asset by that, the lease liability by that. That is the step number 1. Now I will go with the step number 2, which will require us to depreciate. The depreciation is based on the right of use asset divided by the life. This is the amount definitely I will have to use to depreciate. This is going to give us a figure of 15,000 per annum. We'll have to debit the depreciation expense account and credit the right of use asset. Step number 3 is about recording the finance cost. And to work that finance cost, obviously, we will have to do a bit of a calculation. And in fact, which is called as preparing a table of lease. So I can at least write the double entry and then come to fix it in the figure of that in a while. Even I can write down the step number 4, which is a step of making a payment of rentals. So we'll have to debit the figure for the lease liability and credit the bank. The payment, we can write that in advance because the payments of rentals are fixed. The payments for the rentals are fixed, 17500. A debit of lease liability account and a credit of bank. Oh, this is called as a table of lease. And this table of lease will have number of columns and number of rows, like a grid. It usually have 5 columns. And this is how the way they will go, like opening balance, then the interest, closing balance, rentals, and final closing balance. So the opening balance of interest, opening balance of the loan interest rate implicit to lease is what? 6.5%. This is the day the year start. It ends on 31st of December 2008. 9, 10, and 11. So 4 rows. The contract life has 4 years to run. So exactly you'll have 4, and you have to write the reporting dates. So that should be the way it will design. And now I need to just start fixing it up. And the moment I will fill up the first row, you'll be able to fill the second, third, fourth easily. Because the closing of last will become the opening of the next year, and then the same cycle will continue. The opening balance of the lease liability will be the one that we have recognized into a step number 1, 60,000. That will go in. And then it's going to be the work of the calculator. $60,000. Taking a 6.5 of that, it's going to be 3,900. When adding that into 60,000, the figure will turn out to be 63900. The rentals are 17500. The figure is going to be 46400. Well, the closing of last is going to become an opening for the next year. And the figure will turn out to be 3016. See, this is how the way that now the whole of the table will have to fill it up. Well, the rentals are because of fixed payment, so they won't have any difference. I even can write them in advance this way. This is 31916. $2075. So it's going to be 33991 minus 17500 16491 this is 1072. See, the last figure that we have got turns out to be pretty much the same as the last installment. And this will be the proof of that. The computation that we have performed is the right one, is the good one. The rounding of problem will be there, like you found a bit of a rounding of issue, which will be a noble thing. But this figure turns out to be so much close to the one that in the last installment, they will come to pay and exit the contract. This table of lease is the most important thing in the entire topic of lease. What we can make out of that after we are done preparing, what we can take out of that as an accountant, because our aim is not to prepare this table of lease. Our aim is to prepare the financial statements. So what we can take out of that and place the same on the face of financial statement. Have you noticed the cost of finance keeps on diminishing as the outstanding balance of the loan keeps on diminishing? Each year, the finance cost is based on outstanding balance. This was something that I was talking about, and now we've applied. Each year, the cost of finance is based on the outstanding balance. So as the outstanding balance keeps on diminishing, the finance cost keeps on diminishing. Although the rate of interest remains to be the same throughout, a contracted rate, 6.5%. Payments of the lease contracts are same throughout. So suppose if I'm standing it on 31st of December 2008 and preparing the financial statements of that year, what can I take out of it? First thing that I will take out of this is going to be the cost of finance. Is going to be the cost of finance, which is going to be 3,900. And the same thing later you'll be asked to answer in objective test questions. You will be asked to answer in objective test questions. And then what is the balance of lease liability are we going to find? The balance of lease liability. Well, the balance of lease liability is 46400. But according to IS1, we must not forget splitting this off into its two parts, the current portion of it, the non-current portion of it. The current portion of it and the non-current portion of it. The current portion of it and non-current portion of it. How to find the current portion of it? See, this is the balance of the liability that we see at the end of this very year, which is the total balance of liability. And this is the balance that we see at the end of the next year. What lies in between is the figure of 12 months. And that is what we will call it as current portion. The movement from the last year's liability balance to the next year is going to be that movement of one next year, which should be called as the current liability of that. So that's the way that you have to find that out by observing 46400 minus 31916. 46400 minus 31916, the figure turns out to be 14484. 14484. So if this is the current portion, the non-current has to be a balancing one. It's going to be 31916. 31916. 31916. Okay with it? 31916. So one objective is that you should know how to prepare the financial statements, including the lease. So you should know, okay, finance cost goes into profit and loss, and this much will go into lease liability. Under the banner of current liability, I will have to place this amount. Under the balance of non-current liability, I have to place this one. And even in objective question, you'll be asked to answer. Calculate the non-current liability at the end of the first year or second year, or current liability, or finance cost. So you'll be selecting that one, or this one, or liability current, non-current. And you can be asked to calculate the answer of any year. Not necessarily it's going to be a first year. They may ask you to calculate the finance cost of second year. Then you will have to choose this one. You can be asked to calculate the liability current of the second year. Then you have to find that out. Also that one out to find the current portion in. So not necessarily the requirement of the question to find the answer for first year of the lease. You could have asked us to answer the answer for the second year, third year. You should know how to prepare the table of lease, fill it up with computation stuff. And then once you're done with this whole table, you should know what I have to take out of it. What is the current portion of it? What is the non-current portion of it? Finance cost. To conclude this table, imagine I have been asked to calculate the figures of the first year of the lease, which is what the first year of the lease is, this one. How many rows do I have to prepare? Do I need to prepare the whole table of lease to get me the answer of first year? I've done that at least once because I'm here to explain the way that the table of lease has to go from scratch till the end. But you do not have to prepare the entire table of lease when the question demands you to do one specific thing. Like the question requires me to calculate the figures of first year of the lease. So do I need to prepare whole table for that? How many rows do I have to prepare if I have to answer for one given year? I have to prepare 2 rows for that, because first row will give me the balances of finance cost. But to find the current portion and the non-current portion, we must have to have this figure with us. So this is the conclusion that you make, that if the question requires me to calculate the answer for one particular year, I need to calculate the answer of that year and a next year also to be able to get the current portion of liability and the non-current. Finance cost can still be spotted from that row, but the liability to split off in current and non-current portion, we will have to have the answer of next year with us. While these 2 rows are totally extra, and a waste of time. Should not be wasting. How much extensive that discussion is, you can see that we've spent time on that. Good thing is that we have finished this process. Within that question, not the topic of lease is finished, means this question is finished. The finance cost has turned out to be 3,900. Happily, I have been able to debit. Can you really see the way that this table of lease has been prepared? First time in your life, you people are learning all of those things. Okay, the payment in this question was happening in advance or arrears. Now I will take one question in which the payments will happen in advance, and you will see the difference in that, which is the next one on top of the next page, learning example 8.4. So I will repeat the same process, except the payment will happen in advance, and that will bring a slight change in it, not entire change, slight change in it. So what I can do, I can try to write down all the 4 steps like I did. Step number 1. So I'll have to debit the right of use asset. The second step is about depreciation. Okay, so we are all set to prepare the table of lease for one more time. But before then that, also we have to read the question to see what is given and what is not. Thornton acquired an asset by the way of lease on the 1st of July 8. So this is the day of grant. The lease contract required to have 5 payments. So this is going to be a 5-year lease in advance. So that is the reason why this question has been taken for advanced rentals. The interest rate implicit to lease is 11%. The Thornton's year ends June 30th. Have you noticed they have not provided us with this one piece of information which the last question was provided with? They were providing us with the figure of present value of the future lease payment, which this time the question is not provided. So we have to find that out by ourselves. So let's get to know how to find that value. So I will write those cash flows. And there is going to be a factor of discount. And there we will have a present value. So we have 1, 2, 3, 4, 5. So I will write down those 5 cash flows. Well, the discount factors are given, not given 11%. So we can find them out. Okay, because the payments are happening in advance, which means the very first cash flow that I will pay is on the date of signing of contract. That is not a future cash flow. That is a current payment. That will require to have no discounting. While this one I will pay at the start of second year, which means at the end of first year, and that will definitely require to have discounting. So the discount factor is going to be 0.904. It's going to be 0.81. It's going to be 0.73. It's going to be 0.66. 0.90. 0.81. So 25,000 multiplied by 0.90, it's like 22500. 25,000, 0.81, it's 20250. It's 25,000, 0.73, it's 18250. And we have 25,000. 0.66, the figure has to be 16500. So the value is turning out to be 1025000. So this is that way. I told you that the last week we were working the value in use. We were adopting that same approach. So we will still have to adopt that approach of finding the answers. If the payments were happening in arrears, I would have started discounting it as from the first cash flow. But because the payment was happening in advance, the first cash flow was not discounted. These are the little bits of issues we make while we work the answers, and we pay a price for that. Overall, we know how to discount a cash flow, but these are the silly mistakes we make. So be very alert. The payments are happening in advance. The first cash flow won't be discounted because technically speaking, this cash flow should not be called as future cash flow. This is the cash flow that I have just paid them today on the date of signing of the contract. These are the 4 future cash flows, which will require to have discounting. So if the payments are happening in arrears, then this 25,000 will outflow at the end of first year. Then I will have to start discounting it as from the first cash. So once this value has been found, we can write the step number 1 with that 102,500. I can depreciate it based on to its life. The life of the lease is 5 years. So the depreciation of that is going to be 102,500 divided by 5-year life. It's going to be 20500. And then we will go to compute the finance cost. We'll take the opening balance. Now, payments, because are happening in advance, so I can try to copy and paste this whole table and we'll try to bring the changes into. Yeah, this is going to be the better way to explain because you'll be able to notice the difference in the way that the table of advance now needs to be designed. So firstly, I will have to rub all of these years and the stuff. Okay. And then I can write down the years. First year will end on June 30th, 2009. 30th of June, 2009. 30th of June, 2010. 30th of June, 2011. 12 and 13. So I'm going to write what I will do. I will go to swap these 2 columns exactly. Rentals with the interest column being swapped. Can you see the difference? Because in the case of advance, the moment the year starts, you come to pay a rental. So that has to come up front. And on the remaining amount, you have to calculate an interest for the rest of the whole year. Whereas in the case of arrears, when the year starts, you wait for the whole year to end first, and then you pay. So the whole year, you come to accrue an interest first. But in the case of advance rentals, the moment the next year starts, the first thing that I pay is a payment of rental. So that needs to be exactly swapped. These two columns have been swapped in the case of advance rental payment. This is the value at which the step number 1 has been recognized in the first place. And the rentals are 2,500. 25,000, which I can write them in advance because so 1,025,000 minus 25,000, the figure is 775,000. The 11% of that is 8,525. Figure is 8,6025 minus 25,000. It's 61025. The 11% of that has to be 6713. 6713 plus 61025. It's going to be 67738. It's 42738. The 11% of that has to be 4701. 42738. It's 47439. $47439 minus 25,000. It's 22439. It's 2468. 2468 plus 22439. The figure is 24917. See how close the two of the last figures have turned out to be. This is what I was talking about. The difference that you have found, I told you it's going to be there. But what you need to look at is that this is the amount that we were supposed to pay. And the last payment will come to cover it. The contract will end. So 5 rows been able to prepare. Each year, the finance cost is still being worked based on to that outstanding balance. So the way that the outstanding balance keeps on diminishing, the finance cost keeps on diminishing. The closing of last becomes the opening of next year. The same cycle continues. Well, the table of lease has a bit of a change in it from areas to advance. I hope you have observed that change. And if I'm preparing the financial statements of 30th of June 2009, which is the first year of the lease, this one. So this is the finance cost that I have been able to notice, 8,525. I can come down to write this amount up there, 8,525. Rental payments were 25,000. And this is the liability balance that I have been able to spot, 8,6025. 8,6025. The current portion of that now needs to be found. Now this time the current portion is going to be a different story. In the case of arrears, the current liability was found by finding the whole change in this year's answer to the next year. In the case of advance, the moment the next year starts, the first thing that you come to pay is the rental payment itself. So this time the current portion is going to be a payment of rental itself. That does not include interest. While non-current then is going to be a balancing one, 61025. So there are little bits of differences are there that you must have to respect. In the case of advance, the payment of rental is going to be a current portion. This minus this equals to non-current. Whereas in case of arrears, you come to rather observe the liability at the end of this year with the liability at the end of the next year. The whole change that you observe in it is going to be a current portion. How many rows do I have to prepare if I have to answer the first year? Only one row, because this row will give me the cost of finance. This row will give me a value of lease liability, out of which I know the rental payment is 25,000, so I can find the current, non-current. No need to prepare the next 4 rows. Just that year's row is enough. So for arrears, 2 rows are required. For advance, only 1 row. These conclusions will help you in later not wasting your time in the objective test questions, where the question will specifically require us to answer the values of one specific year. Then you should know for arrears, the 2 rows are required, current year and the next year row. For the advance, just that year's row is required. And I've been able to cover the 2 questions. Within those 2, all the 4 steps have been applied of the single lease accounting model. You people have now understood the way the table of lease has to be prepared for arrears and for advance. You also have seen what we have to make out of those charts, what values and how to derive those values. You even have seen that present value of future lease payments computation in advance. I told you that if it was arrears, I would have started discounting it as from the first cash flow itself. And single lease accounting model is still continuing. Check the extent that this model has, but quite a bit of it we have finished. Extensive or not? So we will take a break for 10 minutes. Once I will resume the session, lot many things are still planned to come to our way in the remaining part of the course. So stay tuned in. I will see you in about 10 minutes to continue the course. Okay, I'm back. Hoping you're also there with me in the continuation of the course of today. So getting back to our lecture notes to see what's written and how it is written. Now you look down into this question because we have been focusing on lease liability, as they are suggesting that they are initially measured at the present value of future lease payments, which you really don't know how to calculate. There is this illustrative example which we can just place it in front and read it through. On the 1st of January 2007, 𝗔𝗶 enters into a 3-year lease for a property. Rentals are 10,000, payable annually in arrears. The payments are happening in arrears. The lessor does not provide any incentives to 𝗔𝗏 and no initial direct cost was incurred. The interest rate that's implicit to lease is 5%. See, in the first place, how are they finding this initial value? Are they using that same technique of writing down those cash flows and discounting them to find the present value? Do they start discounting it from the first cash flow? Yes, they have. Why? Because the payments are happening in arrears. So as I was telling you, if the payments are happening in arrears, you must have to discount. You must have to start discounting it as from the first cash flow. So with which they have been able to record the step number 1. How easy is that to read after you have taken my full explanation on everything? Then comes the depreciation. Depreciate the asset over a 3-year term this way by. And once the answer is received, you will come down to debit the depreciation expense account and credit the asset, which has been the step number 2. And then comes the table of lease. Is this the way that the table of lease we even have prepared? Because the payments are happening in arrears, so the column of interest will be the next one before the payment will come after. This becomes the opening balance from the step number 1. And then we are trying to calculate the finance cost of each period based on to that outstanding balance. Each year, the finance cost is based on to that outstanding balance. See, in the end, when you add the both, it equals to that amount which we will go to pay. Same way the table of lease has been prepared, the way that we've understood. And then after that, they're coming to explain the payments in advance table. And exactly that way, we have prepared the opening balance, the rental column, the closing one, the interest, and the closing one. We have all covered that up. And I'm just trying to show to all of you the lecture notes to really get an idea of where and how the things are written. How to present. Now, presentation thing I have even been able to talk about. That the right of use asset should be presented separately from the other asset. Means in the non-current asset, you will come to record the property, plant and equipment separate, intangible assets separate, investment property separate, and this is going to be another one. Right of use asset will take its own row. While the lease liabilities should also be presented separately. And we also know that we need to split them off into its current non-current portion, which is what we already have done. While what goes into statement of profit and loss, the two things, the interest and the second thing will be a charge of depreciation, which is what they even have come to show it to all of us in the next question. Like under the banner of non-current asset, it is the right of use asset that they are fixing it in. Under the banner of current non-current liabilities, they are fixing in the liabilities current and non-current. While profit and loss takes the two things, and those two things are the depreciations and the interest. All of that we already have done. Learning example 8.5 requires us exactly to do the same. Refer to answers to learning example 8.3 and 8.4. In each case, calculate the current and non-current liabilities, which is what I already have done. At the end of first year, didn't I? See, this was in fact the requirement of the 8.5 learning example I already have done for both the questions. Current non-current liability at the end of first year. Next issue, a little one that can take the next 5 minutes of ours. that what if the payments are non-annual? We've done all the questions so far in which the payments were annual, but can happen the payment pattern is non-annual or biannual, monthly, quarterly. So what we will have to do when the payments are not on annual grounds, because in normal case, the lease term equals to the number of rentals. If the lease term is 5 years, just because the payments are annual, so there are 5 payments. But if the lease term is 5 years and the number of rental payments are 10 because you are paying them half yearly, then how in that case we will have to prepare the table of lease? Because so far, 2 questions we have done. In one question, the lease term was 4 and the payments were even 4. So the lease table had taken 4 rows in. In the next question, the lease term was 5. The number of payments were even 5. So we had prepared 5 rows in the table of lease. But can happen the lease term is 2. But the number of rental payments are 10. So do we have to include 2 rows into a table or 10? The answer to that is you need to provide a row for each payment. And that is exactly you're going to see in this illustrative example. We don't have to do a paperwork for that. Rather, we just can view it and can understand. 𝗟𝗏 acquired an asset by the way of lease on the 1st of January 2008. That is the day of grant, like always. The day of grant, like always. Now, the lease contract requires to have 8 payments of 20,000. 8 payments of 20,000. 6 monthly. Means after every 6 months, they have to pay 20,000. And the first payment will happen on June 30th. Means the payments are happening in arrears because the day that the contract is signed, the day the contract is signed is 1st of January, and they are going to pay the first one on June 30th. So payments are happening in arrears, but the issue is that they are going to pay them in after every 6 months. So 1 year will have 2 payments, you can say, in other words, biannual. So if 1 year will have 2 payments, how many number of years they will take to pay 8? If 1 year has 2 payments, are you listening? If 1 year has 2 payments, if 1 year has 2 payments, then how many number of years will they take to pay 8 payments? 4 years. So the issue is that now, should we have to go and prepare 4 rows into a table of lease or 8 rows? The 6-month interest rate is given as 7%. While the present value of the future lease payments is also being provided, we do not have to find. See, if 1 year has 2 payments and they have to make a total of 8, how many number of years will they take to pay 8 payments? 4 years. So 4 years, in fact, the lease term. So in this question, the lease term is 4 years. Number of payments are 8. As after every 6 months, they have to pay 1 payment. After every 6 months, they have to pay 1 payment. So the number of payments are 8, but each payment is after 6 months. So that means 1 year will have 2 payments. So 4 years will have 8 payments. So that means the lease term is going to be a 4 year. So how many rows do I have to prepare? 4 rows, 8 rows. The answer is 8 rows because we have to have a row for each payment. Now, if you check the solution of that, because the payments are happening in arrears, so they are taking the column of interest on the very next and the rental afterwards. This is the balance that they have provided with which the table of lease has started, while the finance cost is based on outstanding balance. Can you realize they are preparing this row not for 1 year, for only for 6 months, as you can see. And that is going to be the next 6 months. So 2 years to complete that 1 row a year. 2 rows to complete that 1 year. each 6 months cost of finance being worked based on to that outstanding balance. You do not have to multiply this by 6 by 12. No, this figure is already a final one. Why? Because the rate of interest that they have provided is already a 6 months interest rate. So you just simply have to multiply this by 7% to get this. Do not prorate this down to 6 by 12. Or else, if this rate of interest was provided per annum, then we would have certainly prorated that 6 months, because one row has got 6 months in. And to get the cost of finance for 6 months, I would have definitely multiplied this figure by 6 by 12, which right now is not allowed since they already have provided us with the rate of interest, which is for 6 months. Closing of first 6 months becomes the opening of next 6 months and the same cycle continues. This in fact is the answer at the end of the first year. This is the answer at the end of second year. So to find the current portion, I will have to compare these two figures to find the current portion of that, like always. This is going to be the cost of finance for this year. As you can see in the solution, the cost of finance that they are working, it takes the care of the two of those values. What we can see in between 95332 minus 67745 is going to be a current portion, which is 27587. 27587. 27587. This is going to be a current liability. Did they get the same answer even down below? Yes, they have. So the dynamics have not changed, except you rather have started recording the payment by taking its own row, and 1 year has 2 rows. That means the 4 years will have 8 rows. And to get the totals of that, you must have to combine the cost of finance for first 6 months and add that into the next 6 to find the cost of the finance for the whole of the year. This is the balance of the liability at the end of the first year that we can see. That is the balance that we see at the end of the next year. And by comparing them both, we will get the figure of that current liability out. Nothing is so new in it. I hardly, or I would say I have never seen in exam or practice questions of the question bank that the question has tested us on a non-annual pattern. But it is just a thing that you have to be aware of. So I have been able to talk about it also. But mainly it's going to be an annual pattern, which you have to focus more at. So we are completing everything from simplified accounting. We already have completed the part of the lecture notes, writing it about the simplified accounting I have looked upon. Even the part of the lease liability has fully been scanned from the lecture notes. And now we are heading towards to focus a bit more on right of use asset. So we have been focusing a lot on lease liability. Let's try to shift the focus towards right of use asset. Means we also have to learn some further aspects in regards to right of use asset. How to measure it initially and subsequently is going to be the concern of ours, and we're getting into. How to measure the right of use asset. So it starts off by taking the same value as before, present value of the future lease payments. Present value of the future lease payments. Not to forget, you go back to step number 1 of the lease liability. This is the step number 1. At what value we are supposed to record the right of use asset as? Present value of future lease payments, which is what we have done for our couple of questions we have done. So it starts off by the same way. But we will now come to consider topping this up with some other things. Basic thing is still same, but now we are going to top this up with some other points. It's as if initially you people have learned the cost of property, plant, and equipment takes the purchase price. And then lots of things you further add in, like non-refundable taxes, transportation and handling cost, installation cost, professional fees, own labor cost, borrowing cost, test runs cost. So the cost is not just the price that you pay, but it takes lots of other things. Right now, this is the basic value that by anyhow you have to record the right of use asset at. But then if the question provides us with some other factors, you must have to top them up in. The first one is the initial direct cost incurred by the lessee. The word direct means this cost is directly associated to the contract of lease. That if the contract of the lease was never taken, this cost would have totally been saved. It's directly associated to the contract of lease. The word initial means it's one-off in the start of a contract, not recurring. Examples could be like, legal cost. You may have paid one-off that legal cost at the time of signing the contract. So this cost is directly associated to that contract that you got in, and it's one-off initially. Lessee, because has paid that out. So it's a cost to a lessee, because practically speaking, sometimes the lessor takes the responsibility of that. So it all depends upon who has been taking that burden. So by lessee only when it will come. Payment before the start of the lease by the lessee. Now, what sort of payments I am talking about? I'm talking about the one-off deposits. I'm talking about the deposits before the start of the lease by the lessee. Payments before the start of the lease by the lessee. Payments before the start of the lease by the lessee. So paying a deposit is even a cost to a lessee. It's a one-off payment, which obviously will top up into the future lease payment, because future lease payments will take recurring rental payments. Deposit will just be an addition to that as an extra cost to a lessee in taking the asset out on a lease. Future site restoration and dismantling cost payable by the lessee. This is what you people also have seen back in while you were computing the cost. If I have to show and take you back to that, because your memory is pretty weak and becomes more and more weak when you don't revise. Long way back when we were starting this course and the first most reporting standard came to our way, this future site dismantling and restoration cost was one of the costs that we have topped it up in while computing the cost of property, plant, and equipment. Remember that. So same way it's gonna add into a leased asset. Asset is asset. May it be a property, plant, and equipment, or you take them on a lease now. This will be the same thing you have to top this up in. So I guess no further talk is required. What is dismantling cost? Today you are taking an asset on a lease and you will prepare a site to fix it, and then you will install it. Once the contract of lease will expire, you will dismantle it. You will bring the site back to its original state, which is called as site restoration cost. So just the way it was considered to be the cost of that property, plant, and equipment, it will even be the cost of that right of use asset. No further talk. As long as the lessee will pay. If the lessor is, then it will not be added. Less the lease incentives received. What sort of incentives are we talking about? So some sort of favors. During the process, the lessor can agree to deliver that asset to your location without charging you. So it's like an incentive to you. It's like a favor to you. So you will have to minus it, because it's not going to cost you. It's going to cost to lessor. You will have to minus it. Lease incentives received by lessor. So you'll have to minus it. It's the only one component that needs to offset. The rest will add. And this is how the way the final value of the right of the use asset will be finalized, with which we will go to record a double entry. So the real question mark is that these components that we are trying to learn, they affect the right of use, fine, but do they affect the lease liability on the other side also? The answer is no. The lease liability will still be valued by using the present value of future lease payments, like always. It's the right of use asset that will take all of this stuff. Then the next question mark is that, then how we are going to balance the double entry then? Because the first step, if you can remember, was right of use asset account debit, lease liability credit. So we have to have a same value When I'm telling you that the right of use asset will take this value, lease liability will only take this value, then how will the double entry be balanced then? To understand that out, I can take one question where I can also come to show to you the corresponding other effects, that what do we have to debit and credit. Other than that, you will come to see it in learning example 8.1. This is the talk that we have been having, the measurement of right of use asset. First, they come to define, and then initially at cost, subsequently, we take the initial measurement of the lease liability. Initial measurement of the lease liability equals to present value of future lease payments. Lease payments made by the lessee before the commencement, deposits, initial direct cost by the lessee, dismantling restoration costs, and lease incentive. This is what I've been talking about. And they come to explain what is lease incentive. Payments that have been made by the lessor. Like I told you, the lessor can agree to deliver that from the location to my location, so have to pay a delivery charge. Or it can be in a way that I will incur a delivery cost, but then lessor later can come to reimburse me, provide me a refund of that. So that refund to me is like an incentive even. Initial direct cost, I already have defined. Any incremental cost that the lessee would incur. If the lease was not arranged, this cost would have totally been saved. See, this is that thing that I even have talked about subsequently. If the ownership does not or does transfer, we take the useful life. If it does not, we take a shorter of useful life in the lease term. I definitely have explained that to you while I was discussing on the depreciation. So we are going to do this question. Learning example 8.1. So A acquired a new asset by the way of lease on the 1st of Jan 2008. The asset had a fair value of 135500. And the lessee lease contract required to have 4 payments of 40,000 to be made annually in arrears. The question starts off by that typical way that they have to pay 4 payments of 40,000 in arrears. The interest rate that's implicit to lease is 7%. And the initial measurement of the lease liability is 135489. So they even have provided us with that fair value. The value at which the lease liability will initially be recognized alongside. So A paid 2,000 in legal fees associated with the lease. And this is that thing that I was talking about. If A is the lessee and is being required to pay 2,000, this is called as initial direct cost incurred by lessee. As incentive to A, the lessor agreed to pay 30. Who is agreed? Lessor. Now, this is called as lease incentives received. Payable to external company to deliver an asset to required location. So it's the lessor who will do that on my behalf. So like an incentive to me. The leased asset will be used to dig underground to identify the existence of mineral deposit at a specified site. At the end of the lease contract, A is legally required to pay to restore the damaged land. The expected cost of restoration work has a present value of 12500. What journal entry is required to recognize the asset? So I'll start it off by writing the first thing first, the present value of the future lease payments, which is the basic thing. The question has provided this piece of information to us. The question has provided this piece of information to us. The figure is 135489. 135489. A paid 2,000 in legal fees. Lease incentives received 3,400, I will be able to offset as lease incentives received. And then there is a restoration work, future restoration work. 125,000. So this is the value that we have got. So this part of the topic only looks as if something we are doing bigger, but it's not bigger. It's about preparing a list of those costs and add it to get that answer. It's nothing else. So it only takes a space, gives that impression as if we are doing something so much technical, but at the end of the day, this is what we are supposed to do. And I will go to pass the double entry with that. Main thing is to understand is the lease liability side, which we already have done, the table of leases and the rest. 489, 135,489 plus 2,000 minus 3,400 plus 125,000. The figure has to be 146,589. 146,589. Now let me go and pass the double entry. By that, I'll have to debit the right of use asset account. Have to debit the right of use asset account. I will also have to credit the lease liability. Now you will see I'm going to credit the lease liability by the present value of future lease payments. Not with that same value, because what is the present value future? 135,489. 135,489. And then I'm going to credit I will come to credit the bank for the payment of 2,000 initial direct cost. And then I will come to credit one more thing, a provision for restoration cost with the value of 125,000. And the last thing that I will come to record is the delivery expense. So this is how the way the whole of the double entry. It in fact is a step number 1. If you are forgetting, you should not. This is step number 1 of single lease accounting model. And out of that, if I go to take the step number 1 specifically under microscope, that is step number 1. Check this out. And the rest of those figures are just to complete the double entry we've been able to pass. This is going to be the value which I will go to use that for the purpose of depreciation. And this is the value that go into a table of lease. And you will prepare the table of lease like the way that normally you prepare opening balance, interest and all, which is what we're not going to prepare in this question. This side of the topic only has this to learn, that you should be able to balance the double entry by recording some other effects. But focus then at the end of the day has to be on the step number 1, which is this. This confirms to all of you one thing, that the lease liability should only take the present value of the future lease payments. The value that we have found is only for the right of use asset measurement. This is what they wanted us to do, and I have done that. See, when this chapter started about 2.5 hours ago, we were defining the term of the lease, non-cancelable period. Remember? And I was debating it very formally over two, which has got the 2 periods to take in: option to extend, option to terminate. To include that period, it should be certain to extend it. To include the period of termination, it should not be certain. So I have constructed examples over to it very formally, and you're done with that. This is from that page, the discussion was done. Another question, learning example 8.2, which will go to cover. Learning example 8.2. So what accounting entries are made in the years ending on 31st of December 7 in respect of leased property. On 1st of June 2007, 𝗟𝗏 acquired a property by the way of 10-year lease. This is the day of the grant. The present value of the lease payments at this date was $990,000, excluding a deposit of $50,000 that the 𝗟𝗏 has paid in May 7. Yeah, because deposits are paid before the start of the contract. So if the start of the contract is on 1st of June, the deposit is paid on May 7, a month before. 𝗟𝗏 incurred 40,000 in legal fees, which is something that we call it as initial direct cost. 𝗟𝗏 owns the number of properties which it accounts for using by the I-16, the valuation model. It has elected to apply that model to be leased property. At 31st of December 7, the fair value of the property was 1,180,000, and it had got that remaining useful life of 28 years. So let's do the first thing of finding the initial value before we will go to revalue it subsequently at the year end. 31st of December 2007 is the day the year ends, while the start of that has to happen on 1st of January 2007. So the date of the grant is 1st of June 2007. And how many months to run from that point of mark to this? June, July, August, September, October, November, December. There are 7 months. So starting off by finding the value, starting myself off with the present value of the future lease payments. Present value of the future lease payments. The present value of the future lease payment is given as 990,000. Within which I will top this up with the figure of deposits and initial direct cost, or I can just write the word legal cost. Deposit of 50,000 is given, and the legal cost is given as 40,000. So this is the value that we get, 990 plus 90,000, 990 plus 90,000. The figure has to be 1,080,000,000. 1,080,000,000. With which I will go to record a double entry as I was preparing to write the double entry. So there will be 2 credits. Right of use asset account will be debited by the figure of 1,080,000,000. I will come to credit the bank account with the payment of, first of all, let's come to credit the lease liability. And then we'll come to credit the bank with the payment of 90,000, which includes the legal cost and deposits. And again, this is going to be that step number 1. This is that step number 1. Can you really recall? The question does not require me to focus on lease liability. The question rather requires me to focus on right of use asset. This double entry being passed, sending it onto a date of grant. The date of grant is 1st of June 2007. Now let's go to land ourselves on the date of reporting, which is 31st of December 2007. 31st of December 2007, we will have to find the carrying amount which later will be compared to its revalued amount to find the figure of the gain and the loss. To find the figure of the gain or maybe a loss. So how to find that carrying amount? The way that we find the carrying amount in normal scenario, we will use the 𝗟𝗏𝗿𝗔𝗙 and we'll try to depreciate 𝗟𝗏𝗿𝗔𝗙 divided by the term of the lease multiplied by 7/12 because 7 months we already have analyzed, and minus the same from the value gives us the total of so 𝗟𝗏𝗿𝗔𝗙 divided by 10 multiplied by 7 divided by 12 minus 𝗟𝗏𝗿𝗔𝗙. The figure turns out to be 1017,000,000. 1017,000,000. While the revalued amount on that day standing is 1180,000,000. So after you're done computing that value, you fall back to a normal everyday accounting, computing the carrying amount, comparing it with its revalued amount to find the figure of the revaluation gain or a loss. This definitely is going to be a figure of revaluation gain. It's 163,000. We know that this is going to become a part of other comprehensive income. Going to be a part of other comprehensive income. By the time the year end, the two double entries will be passed. The first one will be for the figure of the depreciation, which in fact is a step number 2, which makes me to debit the depreciation expense account with the figure of what have we got here? It's 1080,000,000 divided by 10 multiplied by 7 divided by 12. The figure is about 63,000. And the right of the use asset account will take a credit. And then we will have to try and depreciate the valuation. I will have to debit the right of use asset account with a figure of the gain, which is 163,000, and other comprehensive income will be credited by the same value. Okay with that? So this question was nothing. This page was nothing. It was like you have been provided with any asset and you're trying to find the carrying amount of that so that you are able to value it. This was the talk of the moment, that you should be able to find the value of the right of use asset by including those components in, which only affects the value of asset, not the right, not the lease liability. The lease liability still takes the present value of the future lease payments, which is the same thing we even have done in the previous one. So we are even over to that side of the topic where you people now know how to measure the right of use asset. And sidewise, I always have this tendency to show to all of you the way the things are written back into lecture notes, which is something that I always do that for your peace of mind, for your confidence into your detailed lecture notes. See, this is from where I even have started today from, by defining the lease contract. Same like a picture I was trying to draw in my handwritten notes. The two of those things to go by. The lessee comes to record the two things, primarily the right of use asset by debiting, the lease liability by crediting. We now have spent the time on understanding the right of use asset measurement. The lease liability we already have done before than that. Scanning it out by all possible way, as if you do the X-ray of yourself and you get all of the results by seeing it through to your body, the bones inside of it. That's the way we try to 𝗟𝗃 each topic by of all of its aspects. And once it's done by, we go into practice of it from the equation banks of ours. And I always just in the end of that, I'd ask you that your job is just to come and revise it. That easy job is something that some of you feel lack about, some of you feel lazy about. And this is something that destroys the whole thing, because 95% you have been putting your efforts in by coming into classes, by watching me doing all of that 95% stuff. But when you don't combine that 5% of yours with that, you even make a mess of 95%. For those they don't understand, I'm telling you, it's like that. 95% of the stuff is that classwork. You come in and you watch me doing everything crystal clearly. Questions, board explanations, summaries, detailed lecture notes, practices after once the topic is finished. And then that 5% part is yours that I always require you to revise it. And when you don't do that, you actually make a mess of that 95% also. But that 5%. Why? Because that 5% hardly requires to have about an hour of revision, the whole 6 next days. An hour of revision, the whole next 6 days. Think of that. 24 hours a day that we live in, and you even spend 8 hours of sleep, 10 hours of your work. You still are left up with about 6 to 7 hours that can easily be planned to study 1 hour a day. That you can't even do. At least you can spend a bit of a time on weekends to try and see, okay, whatever the topics of last week was, let me try to go and open the whole of the stuff from the portal. Or if I have downloaded the same, let me open the same from my system and try to review it. If the lecturer has been asking me to revise and practice some unseen questions, let me give it a try. And if I'm not doing that 5% stuff with that 95%, the lecturer already has done that, then I'm actually making a mess of that 95% also. The moment you will realize that your 5% of your effort, the moment you will start seeing the betterment in you, in your preparation, the way that you have been passing and failing your exams in the past, you will see a difference in you. It's like the bottle, the lid of that, you don't close it. Everything in the bottle will pour down. May it be a water, or may it be any item, eatable item, or let's suppose a sand in the water bottle, if you have put into it, but you do not close the lid of that bottle. And just putting the lid onto the bottle will hardly take you about a second or two, or maybe a minute. But you don't put it, the whole sand will pour down, the water will pour down and will be wasted. It's just that. Believe you me that your effort is just going to be that 5% task. You don't do it, you make a mess of that 95% also. And I always have advised you to do that within that week itself. Whatever is going right now on, you have this feeling that you know this topic because you are with me, understanding it. If you use the tomorrow time, like Sunday, to revise the same topic and practice few questions from, it will be the best. But after 10 days, you will have to first of all revise the whole topic from the whole lecture. And this will definitely take more time, where you become a bit lazy, because that much of time you do not want to spend on studies. So I always give you those better ways that you can adapt, which will bring an improvement into the way that you have been studying your exams in the past. But I do not know how many of you they listen to me, because hardly any one of you they ever reverted to me and asked me for the issues they have while practicing the questions. Suggested to me that you're not really practicing, you're not really revising, because that cannot happen that you won't find issues. Look into yourself. If you have not been practicing, not been listening to me, then you have to feel a little shameful about. I do not want to use this word, but it is something that you really have to feel ashamed of. It's been like 7th course finishing in about 20 minutes time. And every time I meet in the course, 10 to 15 minutes, I try to counsel you, which is important. Moreover, where it is important to understand the topic of this lease impairment and all, it is also important to counsel you so that if you are not revising, practicing at your side, you are going to make a mess of even this much of effort that you're putting in. Always to remember that 95% of my effort, 5% of yours, if this will not add in with that 95%, you will make a mess of that 95% also. Lot many topics we have finished, and I always have said, look, you have been provided with 2 question practice banks. Open the other one out, because majorly I have been solving the questions from the BPP. You've been provided with the Kaplan one, the updated one, the new one, the latest one. Make the use of that, practice some 4 to 5 questions out of it. You find some issues, not understanding, come back to ask me for my help. I don't see you people come back to ask me for any issues that you have. It will be too late if you will start doing that in the month of November, because that time you will not be thinking of finding a time to come back to ask me for issues, because you will be even having a less time to study and even complete the course and revise and practice. So you will be probably be then thinking of doing a selective study, or quality of preparation will not be there. You will try to complete everything, but if not effectively, you are prepared on everything. You, broadly speaking, you know every topic, impairment, lease, this topic, but not in depth. You know exactly how to perform the questions of this topic and that. And you go less prepared on the day of exam and end up failing. The month of August is finishing also. You see that time is running so quickly. The next week we will meet up. It will be a month of September. 31st of August. So August has 31 days. So it will be 31st of August. September is starting. How quickly the time is just passing by. We just don't realize the batch starts and it finishes, and the revision courses will come in and it will be a day of exam. Do not know if still you are waiting for something to happen. What is that something that you're waiting to happen first of all? It's been a while the course has started. Take this feeling out of yourself that the course has just started. So I can be casual because the course has just started. The course has just started. No, it's been like 7 sessions we have had. In the past, the course started in the 2nd week of July. Now we are almost at the end of the month of August. Plenty of areas we have finished. The topic of lease is even being finished by 80%. Do not know what you really are waiting for and what do you really want from this course. Sit for a moment and think of it. That is this the way the student of ACCA has to study an exam? By just taking a course from the lecturer and after that not visiting it back, reviewing it, not making the use of services that this distance learning course offers, recordings, soft copies of everything, those are downloadable. Why have you paid for that service if later you're not wanting to take the benefit out of that service ever? Everything will go one day, expires on the day, and then you will be like, I should have taken the care of. The area that we are left from this topic is sale and leaseback contracts. We will keep this into the next course of ours. We will take ourselves to practice kit to work some questions that we can do it from the part of the topic that we have finished, because the sale and leaseback can still take about 45 minutes and we can't complete it today. And it's just another world, by the way. So we will keep that into our next course. But we can, meanwhile, can touch few questions from the exam kits of ours, which will give you a bit of a taste before leaving the course today, that how the questions of the lease are tested. Okay. If I land myself onto a question of this kind, It's from the right of use asset. At what amount does the IFRS 16 requires the lessee to measure the right of use asset? We just have done. So they have rather used the short forms of the whole this discussion. Remember, they have rather used the short forms of it. Lease liability means present value of lease payments, because we know that the lease liability is measured initially at present value of the future lease payments. So lease liability plus indirect direct cost, yes, it's good. Plus incentive, no, incentives are rather deducted. So this is not good. Incentives are rather deducted. This looks to me fine. This does not look to me fine because other direct cost tops up into it. This looks to me fine. This looks to me fine. Prepayments are deposits. Yeah, it's exactly the right option to select. With the question, can even be like that? You have to be smart enough on getting those 2 marks in the matter of 30 seconds. Another theoretical based question, concept based, we can do that. Identify whether the following statements do or do not indicate the contract is lease under IFRS. This kind of a question is called as hot area, where you have to select all the 4 boxes, but then depending on which box needs to be selected. The lessee obtains substantially all the economic benefits from the use of asset. This indicates the lease. Because when the asset is leased out to a lessee, risk and rewards, most of them are transferred to lessee. Most of them, substantially, if not all, substantially, the risk and the rewards of an asset is transferred to lessee. So this thing indicates a lease definitely. Ownership in an asset is transferred at the end of the lease term. I told you that in most of the lease contract, the ownership is transferred to lessee at the end of the lease term, which indicates the lease. Contract relates to an identified asset, that is fine. You take an asset on a lease for one particular asset, and that asset cannot be substituted. Yeah, if you have to take another asset then you have to take that asset under a new contract, not under the same contract. That asset can be replaced. It belongs to that one identified asset and cannot be substituted. If it suits them to do so, the lessor can substitute, and no, this is not. As I told you, cannot. The asset cannot be substituted. Rather, a new contract needs to be signed for that. Under the same contract, the asset cannot be replaced or substituted. Even if it is an identical one, still cannot be. So this does not negate a lease. Now we can take the questions, the computation-based one, which will give you a flavor of, before leaving the course, that how to answer the questions of the lease. What amount will appear under the non-current liabilities in respect of the lease in the statement of financial position? So you see, the question this time requires us to answer that. So that means we will have to prepare a table of lease and find that closing balance, out of which we split the current and non-current, like I did. So we will do that. This is question number 103. Let's go to solve. Question number 103. And it's the page number. Which page is this from? It's from 36. Now, on the 1st of January 2006, Felony Company hired a machine under a 4-year lease. So it's a 4-year contract. A deposit of 700 was payable on the commencement of lease on 1st of January 2006. So the year ends on December 6. The start of that has to happen on 1st of January 2006. This is the day they have taken a lease. The day the year starts, they have taken an asset on a lease. 4-year lease. The present value of the future lease payments are this much. A further 3 installments of 700 are payable annually in advance. So payment pattern needs to be noticed because the table of lease, then we have to design according to advance arrears. The interest rate that is implicit to lease is 6%. The interest rate that's implicit to lease is 6%. Okay, so I'll start off with present value of future lease payments, which in this case is given. What is given? 1871, 1871, 1871, 000. 1871, 1871, 1871, 100. Now this is 100. See, the word future means what they have to pay in future. And in future, they have to pay 3 rentals. So can I say that this is the present value of 3 payments, but the lease has 4 years to run, isn't it? Because they have paid the first rental on the day of signing of contract as a deposit. So that is a 4th payment, which should not be the part of this amount. And I will just come to top this up in. First, I can write it. First installment. $700,000. First installment as 700,000. 1871, 100 plus 700,000. The figure has to be 1871, 100, 1871, 100 plus 700,000. The figure has to be 25711. 25711, 00. See, I was talking about this before. The first installment that they have made is not a future cash flow. It's the cash flow that they have paid today itself. That does not require to have discounting. We just need to top this up like that. So this is the value at which the step 1 will be recognized. And once the step 1 is recognized, I will work the table of lease according to. If I was doing this question for me, I would have not done this whole sort of paperwork. This is just for you people. I would have done the whole thing on calculator. This is the value at which the values have initially been recognized. So right of use asset account debit, lease liability credit. So I will now go to prepare the table of lease. Are you fine with that? How did I get this amount? The payments are happening in advance, so it's going to be an opening balance. Interest will be the 4th one, and then the final balance. I was doing a question of this kind before in my lecture notes, this one, where I was not discounting the first cash flow. The next 4 were discounted. So 3 of those cash flows were further. So the discounted value of those are given, but the first cash flow, I just need to top up like that to find the total value. Make the use of the knowledge being shared to you. I'm not doing anything new in it or extra over here so that you feel confused about. This has been the discounted effect of 3 cash flows, but there are in total 4 payments. The first payment is the payment that they have made itself on a signing of contract. I'll just need to top this up like that. See, this is not a future cash flow. These 3 are future, so they have discounted. Total value is this, with which the table of lease will take 2571000. They want me to calculate the answer of first year end. So let me write it, 31st of December 2006. It's going to be 2571100. I will come to deduct the first rental out of it to get me the figure of 1871, 1871, 100. The rate that is implicit to lease is given as 6%. The 6% of that is going to be 112266, 112, 112266, 112266. Adding that into 1871, 100. This is the figure that I have got, 198 3366. So this is the balance of the liability that we get at the end of the first year, and we have to split this off into its current and non-current portion. The current portion of that is going to be the payment of rental itself, while the non-current portion is going to be a balancing one, which is going to be 1283366, 1283366. And this should be the option for us to select. And obviously this one, because it has been rounded off. The questions of the leases are going to be time taking, as this one was. And you will not be able to get that answer like that. You will have to do a proper work on that, effort on that to get down to that answer. But this work, whatever we have done, is not the first time we have done. We are using the knowledge of our class explanation in getting down to those figures. I always come to prove it time after time that while come to practice these questions, we practice these questions by using the knowledge of our class explanations, not I try to bring something new while questioning these. This is how the way the questions of the leaser are going to be like, and we will do plenty more the next time, like the one this we have done. At least I will do 2 to 3 questions of this kind the next week when we will meet up, and we'll also try to finish it off this last topic of this chapter, sale and lease back. All in all, I feel that this chapter can take still the half of the course of the next week. As I told you before starting the course, that this is going to take us the whole session of today and even the part of the next to finish it by. It's a big chapter. The sale and lease back will roughly take about 45 minutes, while if I try to include some more practices next time, can take other 45 minutes. So roughly the half of the course the next week will still be focusing on lease before we will be able to start with chapter 9. And you have that same job that I always demand, to come up with a revision of whatever we have done, so that the next time we will meet up, we can start the next course of the lease with the same flow, the same momentum that right now we are in. Concludes the course of today, concludes the topic of the movement. So I will see you the next week to continue the topic of lease. Have a good rest. Have a good weekend. Thank you very much.